My colleague Zara made $95,000 last year. She drives a decent car, lives in a nice apartment, takes one vacation a year. From the outside, she looks financially solid, but last October, her landlord raised the rent by $400 a month. She couldn't absorb it. She had to borrow from her mother at 34 years old. That night, she called me and said something I haven't forgotten. She said, "I don't understand. I earn good money. Where does it go?" I told her. "The problem isn't where it goes. The problem is the rule you never learned." The rule is 40%, not a savings tip, not a budgeting hack, a hard ceiling. If more than 40% of your take-home pay is committed before you make a single choice, you are not managing your money. Your money is managing you. Most people in this situation don't feel broke, they feel busy. That's the dangerous part. Every personal finance course tells you to track your spending. Download an app, color code your categories, know where every dollar goes. That advice isn't wrong, it's just 10 steps too late. By the time you're tracking, the damage is already structured into your life. You've signed the lease, you've taken the car loan, you've enrolled in the gym membership, the meal kit, the streaming bundle. These aren't choices anymore. They're commitments. They auto-deduct whether you had a good month or a bad one. Tracking them is like counting water after the pipe has burst. The 40% rule stops the pipe from bursting in the first place. Here's what 40% means in real numbers. If you take home $4,000 a month after tax, your committed expenses, rent, car payment, loan EMIs, subscriptions, should not exceed $1,600. The average person watching this right now is sitting somewhere between $2,000 and $2,600 in committed monthly obligations. That's 50% to 65% of their income locked before the month even begins. What happens to the rest? Groceries, fuel, eating out because they're exhausted from working to pay the first 60%. Small purchases that feel reasonable in isolation. Another subscription, a sale they couldn't ignore. By month end, zero. Not because they're reckless, because the foundation was already broken. And here's the part nobody calculates. The cost of being over 40% isn't just that you can't save. It's that every unexpected expense becomes a crisis. Your refrigerator dies, $700. Your child's school asks for a field trip fee, $80. You feel that $80. That feeling, that low-grade financial anxiety that follows you to dinner, to sleep, into Monday morning, that is the tax you're paying for violating the 40% rule. It doesn't show up on a bank statement, but it is costing you more than any bill you pay. I am not telling you this from a position of perfection. At 29, I was earning $62,000 a year. I felt like I was doing well. My rent was $1,400. My car loan was $480 a month. I had 2 credit card minimum payments totaling $290. That's $2,170 in committed obligations before I bought a single meal. My take-home was roughly $3,900. My committed percentage? 55.6%. I wasn't spending frivolously. I was just structured wrong. The math that broke me wasn't dramatic. It was slow. Over 4 years at that structure, I estimated I lost approximately $38,000 in investment opportunity. Not because the market was bad, because I had nothing left to invest. That $38,000 invested at 10% annually over 20 years would have become $255,000. I didn't spend $255,000 irresponsibly. I just never learned the 40% ceiling when it still mattered. Right now, some of you are thinking that number is impossible in a high-cost city. Rent alone is 40% for a lot of people. I understand that, and I'm not dismissing it, but here is the distinction that matters. If you are in a city where rent alone exceeds 40% of your income, you do not have a budgeting problem. You have a location versus income problem. No budgeting app fixes that. No discipline fixes that. The only solutions are increase income, reduce housing cost, or accept that you are operating in a structurally deficit position and plan accordingly. What I'm telling you is, most people who are over 40% are not in that situation. Most people are at 52% or 58%, not because of rent alone, but because of rent plus a car payment plus an EMI they forgot they had plus 3 subscriptions they stopped using 6 months ago. That version is entirely fixable. Let me show you what this looks like at a higher income level, because this is where it gets uncomfortable. My friend Daniel earns $130,000 a year. His take-home after tax is about $7,800 a month. His committed expenses: rent $2,600, car lease $720, gym and subscriptions $180, 2 loan payments totaling $940. That's $4,440. His committed percentage: 56.9%. Daniel has almost nothing left after living expenses. He's not struggling day to day, but he is not building anything. At 39 years old, he has $47,000 in his retirement account. At his income level, to retire comfortably at 65, he needs roughly $2.1 million invested. To hit that number from where he is today requires investing approximately $2,800 a month for the next 26 years. His current available surplus after living expenses and discretionary spending: under $1,000 a month. Daniel is not going to make it. Not because he earns too little. He earns more than 91% of Americans. He is not going to make it because his committed percentage is structurally too high. And it has been that way for over a decade. His lifestyle quietly priced him out of retirement while he was busy upgrading it. So what do you actually do with this? You run one calculation. Right now, take your monthly take-home, multiply by 0.40. Then write down every committed expense you have, every single one that auto-debits or requires a formal process to cancel: rent, car payment, loan EMIs, insurance premiums, subscriptions with renewal dates. Minimum credit card payments. Add them up. If that number is above 40% of your take-home, you have a structural problem, not a discipline problem. Discipline will not fix it. You need to reduce one large committed cost. Not cut your coffee. Not track your groceries more carefully. Cancel a forgotten subscription, yes. But more importantly, when your lease comes up, consider a cheaper apartment. When your car loan ends, don't upgrade. When you get a raise, do not immediately commit it to a new expense. That last point is where most people break the rule without realizing it. Every raise feels like permission to upgrade a commitment. It isn't. It is an opportunity to lower your committed percentage. Zara, the colleague I mentioned at the start, after that phone call, she sat down and ran this calculation for the first time in her life. Her committed percentage was 61%. She didn't have a spending problem. She had a structure problem. Over 18 months, she made 3 changes. She moved to a cheaper apartment when her lease ended. She let her car loan finish and didn't replace the car. She canceled 7 subscriptions she had forgotten about. Her committed percentage dropped to 37%. Last month, she told me she has started investing for the first time, not because she got a raise, because she finally has room. The 40% rule doesn't require you to earn more. It requires you to stop signing your future away before the month even begins. One calculation. Run it tonight. And if that number scares you, good, that fear is useful. The number that scares you tonight is the number that changes everything by next year. Drop your current committed percentage in the comments. I want to see where people actually are. And if you want the exact framework I use to rebuild a financial structure from scratch, that video is right here.